Ping, welcome to Global Tax Talks.
Thank you for inviting me, Will.
Good, well, it's great to have you here. So look, let's talk about Indonesia.
Sure.
Home to the world's fourth largest population, 275 million people spread across this enormous archipelago. Also one of the world's most important economies, member of the G20, ranking 16th globally in GDP based on market prices. And Indonesia has been a key partner of the OECD since 2007 and actually applied to join the OECD in July 2023. So Ping, can you talk about Indonesia's increasing involvement in the international tax scene, including the recent G20 presidency, and what changes to the Indonesian tax regime do you think we may see from a tax policy perspective if the OECD accession goes ahead?
Wow, that's a long question, Will. But okay, so probably I can explain a bit on that. So yes, for almost 2 decades, right, Indonesia's engagement with the OECD as a key partner has played a more active and influential role through various policy dialogues, peer reviews, and global forums. Specifically on taxation-related aspects, you can see how Indonesia support internationally agreed standard on transparency and the exchange of information. Indonesia has ratified its commitment to information exchange, both bilateral and multilateral, automatic exchange of CBCR, and we participate in the common reporting standard, right? Indonesia also participated in multilateral tax agreement in 2017, and we deposited the instrument of ratification in 2020, which essentially modifying for more than 47 tax treaties to align with the MLI. Since the introductions of the BEPS projects, Indonesia has been actively involved as a member of the inclusive framework to participate on equal footing in the development of the standards on BEPS-related issues, while reviewing and monitoring, of course, the implementation of the BEPS project. Several inputs from the BEPS project that are relevant to the Indonesian economic landscape have been accommodated into domestic tax regulations, such as the debt-to-equity ratio, the CFC rules, and the continuous update on the transfer pricing rules to be more aligned with the OECD guidelines. And yes, that Indonesia has officially announced its interest in becoming a member of the OECD July last year. Indonesia hopes to enhance its global reputation, influence, and competitiveness. Especially Indonesia would be the only South Asia member country, I believe. If the accession process moves forward, Indonesia can expect to benefit from the access to the OECD's expertise, tools, data, benchmarking, as well as to have a greater voice and influence in shaping the global norms and standards, which would be crucial to Indonesia in achieving its aim to get the developed country status by 2045. That will be our 100th anniversary of our independence. Certainly, Indonesia may need continuously have to undertake adjustments, which include to its tax regime to meet the OECD's expectation and requirements. And so far, Indonesia has taken significant steps to align with the tax system with the international standards and best practice. The significant reforms started since 2020, for example, with the issuance of Omnibus Law, followed by the Harmonization Taxation Law. Again, if the accession process moves forward, we also would expect that Indonesia would be more engaging in the OECD's peer reviews, global forums, evaluation, and to help us faster learning and adoption of the best practice, tax administration across countries. And as the only member country of South Asia and the emerging country, Indonesia can shape more diverse and comprehensive and inclusive global agenda and policy on various issues, including tax. We also would expect that the OECD's guideline and principles on various tax issues, such as transfer pricing, the hot topic, tax treaty implementation, will be used, and this could make the dispute resolution mechanism be more effective.
Thank you very much, Ping. That was great. So we look forward to Indonesian accession. But let's come right down to the present and the subject that nobody can avoid, Pillar 2, and the minimum tax, which continues to dominate headlines. Now, Indonesia has not enacted legislation, but it's announced its intention to do so. More on the Pillar 1 side, though, the government apparently has introduced regulations to acknowledge a new concept of allocating taxing rights without the need for a physical presence. And that gives broader taxing rights, obviously, to the source country, which is a distinct theme of Pillar 1. At the same time, Indonesia continues to promote efforts to be an investment destination and to be internationally competitive, and may include further tax measures on this in the future as well. So how will Indonesia, do you think, strike the right balance between taxing more, potentially under Pillar 2 and elsewhere, while at the same time trying to attract in that foreign investment?
Always the common questions.
Indeed.
Not the direct answer, but okay, let's see. Yes, Indonesia has committed to support the OECD plan for two-pillar solution. And from the domestic level, the potential adoption is actually on the two-pillar solution has been included in the latest amendment of law. So the framework is already there. So again, since 2020, the regulation requires for the foreign e-commerce companies, for example, to register and collect VAT. So this is at least to create a level playing field with the domestic business players. The regulation also explained that the new concept of the allocating taxing rights will only be applied at this moment, if not against the content under the relevant tax treaties. So I think that it is reasonable to say that Indonesia's directions toward policy on the allocation of taxing rights, it may tend to denote to Pillar 1 solution from the OECD that is viewed as reliable to attract multinational companies to do business in Indonesia. And they recently released OECD final report, right, on Pillar 1 Amount B that is intended to simplify and to streamline the application of the arm's length principle to baseline marketing and distribution activities. Will also give certainly for broader taxing rights to Indonesia as the source country. And I believe that most will agree on the significance of the market potential in Indonesia, right? And therefore, as earlier mentioned, that Indonesia undertook significant reform on laws, regulations, policy, not only tax, is quite broad, to provide more certainty. And in the tax context, is easy in the tax administration. Through technology integrations is a big thing. For the Indonesian DGT now, transforming their digital reporting. And of course, the transparency, which hopefully can reduce the compliance costs. And also Indonesia upskill the human resources in many areas, aim to resolve tax dispute in more effective ways via MAP, the mutual agreement procedures, and also for the advanced pricing agreement. So I hope with all this will help Indonesia to become more attractive investment destination.
Great, thank you very much, Ping. Okay, so let's move on to one last topic, another hot topic, sustainability, ESG. And towards the end of last year, 2023, the Indonesian Stock Exchange launched an Indonesian Carbon Exchange, IDX Carbon, which is another milestone for Indonesia in its commitment to meeting the net zero standards by 2060. Now, tax functions inside of businesses are obviously helping to address the added costs and compliance burden associated with this, but they can also help businesses identify taxes and credits and incentives that can potentially help fund those sustainability initiatives. So Ping, how are global tax functions responding to these sustainability challenges?
Oh, okay, sure. Well, possibly the single and most glaring impact to the global tax functions in relation to net zero would be the carbon-related taxation, right? Some areas for global tax function to focus on, of course, any tax function would first need to identify which of group company is required to pay carbon tax. Does the company have sufficient technology, data to enhance their tax reporting and compliance? And besides ensuring compliance, tax functions should also understand on how carbon tax will impact to their business, bearing in mind that carbon tax is not necessarily based at statutory rate, but could be based on market price on carbon credit or carbon offsetting, right? Of course, it is challenging for tax function to examine the business carbon cost under the future under the future price scenario. On this basis, tax function may also consider identifying opportunities to minimize carbon tax by way of carbon credit. Participating in carbon projects could be one of the example, right? And next, relating to the carbon adjustment, which may affect the product competitiveness. Cost of a carbon footprint is not only a domestic affair. It would have a global impact for a cross-border movement of goods, started with CBAM, for example, and possibly rolling out to other parts of regions. The carbon wall could impact to the product competitiveness if the product that the company produced is not within the acceptable carbon footprint, right? So the global tax function would also be at the front end of monitoring any tax developments happening globally in sustainability aspects. Carbon wall is, as I mentioned earlier, one of the examples. Tax functions should monitor and map out the possible impact to their business and closely work together with the product operation or supply chain function. And also global tax function can also work together, say, with the business development team to find new business opportunities in decarbonization sectors, which is eligible for fiscal incentives, carbon credits. And by working together across different departments, the global tax function, again, can drive added value to the business. Last but not least, at this moment, everyone is learning. This includes the tax authorities, regulators, industry associations. So the global tax function can also contribute to the development on the implementation of the policy, give inputs to a fair and balanced tax system that supports sustainability objectives. So in conclusion, as part of the net zero commitment with the development of the taxation on the carbon footprint, the tax function should be now more connected to the business. Tax function task is beyond managing the tax costs and compliance, but they can give impacts to a wider stakeholders.
Thank you so much for joining us and for giving us this insight into really one of the world's most important countries, but perhaps not the best known of its countries. So this has been absolutely fabulous, and we will look forward to getting you back again.
And hopefully I see you in our most beautiful country, Indonesia.
I will look forward to that. Thank you very much. And thank you for joining us on Global Tax Talk. Come back again so that you stay global tax ready.